You're listening to Accounted For, the Canadian podcast that explores the intangibles of every career. I'm your host, Daniel Lee. Hello. Welcome back to Accounted For. Thanks again for tuning in. This podcast is brought to you by OMD Ventures, my platform focused on everything human capital investing. Check out weekly articles on redefining the status quo in work and life, as well as my daily learnings on becoming healthy, wealthy, and wise at oldmandan.com. And be sure to subscribe to the newsletter that will provide you with the weekly updates with all the new material. And also help out the podcast, as well as a friend you love, by telling that friend this week about Accounted For and why that person should listen to the podcast itself and how it'll help their own career journey. Also, what would really help me to improve the podcast and the overall OMD Ventures platform is to really learn who you, my listeners, are. I made a survey that I would really appreciate if you would fill out. It should take no more than 5 minutes, and you can remain anonymous. And so don't worry, I won't come after you if you do the survey. There's no way for me to know who you really are. And so please make the time to head on over to oldmandan.com/podcasts with an S to fill out the survey link. I'll also link everything on the show notes description as well, so no need to memorize any of that. And so today's interview is with Jason Zan, the fractional CFO of 4 startup companies. So he's the CFO of 4 companies at the same time. Jason has had more than close to 2 decades worth of experience in Toronto's tech ecosystem, starting in the hot 90s period when he started a website agency company to then eventually starting a global VoIP company. VoIP, for people who are not familiar, is voice over internet protocol, and so it was practically the way that people made, or one of the ways that people made long distance phone calls using the internet. You know, like how we have FaceTime and like Facebook video chat now. Yeah, so back in the day, just even a couple of decades ago, it was much harder to do that kind of stuff, and more expensive too. And in between his entrepreneurial ventures, Jason, and I quote him when he says this, he ping-ponged from being an early stage venture capital investor to being the CFO of early stage startups. So he just constantly went back and forth from doing that while he was also starting companies in the meantime. And despite being a CFO, he does not have an accounting background, and this is something he brought up when I first reached out to him. And we talk about how the CFO role is evolving, and it's not just for the traditional accountant anymore. We also talk about entrepreneurship, how raising money isn't success, what the 3 duties of the CEO actually are from his experience being an investor, and how after his 3rd foray into venture capital, he finally was able to figure out that he wanted to be a CFO and why, and what the reason behind all that was, what really was the big difference between his desire to be an investor versus an actual operator inside a startup itself. This was really, I think, a really fun journey where Jason just shares his kind of wisdom, being on the both sides of being an operator and investor constantly as the landscape is changing. And so I had a lot of fun talking to Jason about that. And I really hope you find as much value out of this as I did as well. So without further ado, here's my conversation with Jason Zan. Hey everyone, welcome to Accounted For. Today on the podcast, I have Jason Zan. Hey Jason, thanks for coming to the podcast.
Nice to meet you.
Jason is a fractional CFO of close to, I think, 5 startups, right?
And 4 right now, yes.
4 right now, yeah. Okay. So for the listeners, what are the 4 startups that you're currently the fractional CFO?
One is a video content syndication platform. Another one's enterprise-grade data collaboration platform. Another one is a cannabis media property. And the final one is a platform for financial advisors.
Gotcha. And for the listeners who may not be familiar with the term CFO, it's Chief Financial Officer. And for you, Jason, how would you define, in your own definition, what a CFO is? And do you think it's really different from what people might perceive it to be?
So my definition, at least in my world, I define it as a person that helps the founders or the CEO get a forward-looking view on their company, right? So how do I predict the future, and so that I can plan for that future, right? But in order to do that, you actually have to have visibility into the present and into the past. So the two pieces are, number one, sort of forward-looking, looking to the future, and then defining and putting in all the infrastructure so that you have visibility into your current state and your past. That's what I define a CFO as.
Got it. Yeah, I think I don't know how the market might view it, but I remember back in school when we talked about CFOs, we just imagined someone who's just in charge of everything numbers related in a big company.
Yeah, and I think that's true in a lot of cases, right? Because I mean, obviously with scale, you've got a lot of data, right? And you've got to figure out how to actually sort of report on that data in a format that allows you to actually understand it, and then to be able to actually analyze the data to actually get reasonable information out of it, so that you can, point your company in the right direction. I think, though, historically, the focus of a lot of CFOs, or when people think about CFOs, is they think of like an accountant who's sitting there and just reporting on the numbers, and that's true, right? That's very, very important. And historically, it's been about accuracy, right? Making sure numbers are either compliant to GAAP or IFRS or whatever else, and making sure the numbers are accurate. But what I'm seeing right now is that as we progress forward, specifically in technology companies, and almost all companies are becoming data-driven, right? So having visibility into that data above and beyond the product is very important, and that's the data of the business. And I think that's where sort of that CFO role is evolving to.
Yeah, I remember when I first reached out to you to chat, you immediately responded back with, "By the way, I'm not an accountant. I don't have an accounting designation. Do you still want to talk to me?" And I said, "Yes, that's exactly why I want to talk to you." Do you get that a lot, where people ask, like, "Do you have an accounting designation?" when you tell them you're a CFO?
Yeah. I mean, most people do. They say, "Oh," when the first thing they say is, "Are you a CA, CPA, CMA?" And I say, "No, I'm not actually." My background, actually, in terms of my understanding of accounting and everything else, was as an operator myself. So I had started up 2 startups myself, and also as a venture capitalist. And it gives you a different view. I mean, you have to understand the financials and understand what each line item means and what the balance sheet means, cash flow, and all the items. But the purpose is not so much about, the assumption is that it's accurate, right? And the purpose is to figure out, okay, what can I learn from the past with these numbers so that I can better manage my business in the future, right? And I think historically, the focus has been, all this guy is just to make sure this CFO or VP finance or accountants is just focused completely on accuracy and making sure that the financials, whatever numbers, are accurate to a specific, I'll call definition, standardized definition, as I said, whether it's GAAP or IFRS, whatever else it is.
Yeah. And I remember when I was looking through your profile, you've had more than 20 years of experience in the startup realm. And even so, you kind of started off in like the 1990s when tech was hot, and then all the way continues even after the bubble burst, even until now. Did you always know you wanted to go into that startup world? Like, how did that happen? Were you from like an entrepreneurial family where you just saw it and said, "Okay, that's the world that I'm going to be part of"?
No, actually, you know what? It's kind of funny. So I went to school for business. I did my undergrad at Western, and it was a business degree. So I did know that I sort of wanted to get into business, but I didn't know what I really wanted to do. And my first entry into the business world was actually in packaged goods. So I worked for Procter & Gamble for a while. And then, I came to realize that, moving, the amount of share ownership of Tide by 0.5% didn't really excite me, right? And it wasn't really what I was interested in. And then I'd always been interested in computers and technology growing up. I sort of programmed as a kid for fun and was into tech. And then about the time that I graduated and I come out of school, this was in the mid-90s, like the internet bubble just started to boom.
It got pretty hot then, right?
Yeah, it was just right at the point when there was basically Netscape 1.1. And I said, whoa, what is this? This is super, super cool, right? And then so I decided, hey, you know what? I just, although Procter & Gamble was an amazing experience, I didn't have that much of a passion for it. And I decided, well, you know what I really want to get into is technology, and this looks super, super cool. So I joined up with a small professional services firm that basically built websites for banks, financial institutions at that time. And that's how I got my entry into the internet world.
Was that company iMoney.com?
No, that was a company called Quadrivision.
Oh, okay, that was the Quadrivision.
Yeah.
Got it. And during that time when you were choosing, do I go back to this Procter & Gamble world or do I follow this tech world? Was that a very popular decision back then amongst your peers as well, or were you still the outlier to see that and say, I'm going to jump on this?
Yeah, I think I was still, very much the outlier. I mean, at that point in time was like Netscape 1.1. Like most people didn't even know what the internet was, right? So this is time of Telnet, Gopher, and like a lot of stuff that like the current model of the internet didn't really exist. Mm-hmm. So I think there are individuals that said they wanted to start their own businesses, but the internet wasn't really a space that was well known at that time.
And you continued on with this technology world. So you were at Quadrivision, and then you moved over to. That's when you went to like iMoney.com. Is that?
Yeah. So then I left and I started my own professional services firm. So what I found the big gap at that point in time is that there were a lot of companies that were producing websites that were purely for marketing. So it was about the pictures and the content and the words, right? And there was that sort of space was burgeoning, right? But a lot of these companies didn't have that strong of a skill set or a domain expertise in building out functional websites, right? Calculators, what we take for granted now, right? So I had said, okay, I did this. I had to build a whole bunch of websites, like Comerica's website, BMW.ca's website. They're like the first versions of it. And I said, hey, you know what? I'm going to go off and start my own first business, right? So I decided to create my own web building business, right? That focused specifically on functionality. So our customers were other websites or other agencies who had clients, and they had built up, they were focused on the vision, like the visuals and, the content. And then whenever they needed like any functionality, they would subcontract to us, and then we would build those pieces out.
Was that when you used like your programming skills from back before like university to actually start building a website?
Yeah, basically. So that was back at that point in time, and it was a very, very different world back then.
Yeah. And so the bubble pops, and then you pivot into going to the venture world. It seems like with Rogers.
Yeah. But what actually happened was still during the bubble. I won't call it the bubble. I'll call it the gold rush.
Got it.
I'll call it the gold rush.
Yeah.
And at that point in time, I think every single large media property out there, a large company who was in media saying, oh man, this is the way of the future, or at least I'm seeing all these incremental increases in valuations, all these internet companies. I got to be there, right? So Rogers is one of the companies that had decided, hey, we as a media company, we need to be in this space, right? So they had created Rogers Interactive Media or Internet Media, and they were looking for people to help grow this sort of sector. They, at that point in time, no one knows what they're doing. They're trying to figure all this out, and it was either, do I build a property? Do I partner? Do I buy? What do I do, right? And Rogers at that time was saying, okay, let's see what we can do between all three of these items, right? So the fact of the matter was that by this time, there weren't that many people out there that had any real significant experience in terms of actually being able to build out websites and actually the business models around these elements, right? And just because I got into it early, I had a bit more experience than everybody else. So I was brought on to assist not only with the development of the business models of their version of the incubator back at that point in time, but also to help with evaluating investing in potential investments in the internet world, because obviously the valuations and opportunity within that space is going up so much.
And I think you were still, when you were in Rogers during your tenure, the gold rush practically kind of dwindled down and in like early 2000s. And what was the kind of investing sentiment like at that point in the environment?
Oh, it was tough. I mean, it was very, very tough at that point in time. I mean, like a lot of experience in terms of how to deal with tough situations, right? I mean, when things aren't going that well and things are flying through, you have to make some tough decisions, and you have to, restructure your investment deals, try to sell in secondaries. You have to do a whole bunch of other things, right? Which aren't that fun, right? Whereas trying to like refocus on the deals that that will make it through that sort of trough, right? And to push down on these individuals, unfortunately, and get them to really, really bunker down and cost cut and focus on the core until you can sort of get out of that bottom of that J curve.
And is there like a particular tough decision like that comes to mind, like an example?
Yeah, the simplest is your burn is too high. You got to cut it in half or more, right? And unfortunately or fortunately, most of the burn in tech companies is employees, right? And when you're starting up somebody, you get close to these individuals, and especially with a smaller organization, you know everybody by name. So having to be the CEO or the founding team and go to half these people and say, I'm sorry, but you know what? The market has turned, or the situation has turned, and we're going to have to cut our costs is a very, very difficult thing,
And despite that difficult time frame, you then went off again to start your own company, and this time it was the kind of voice over internet protocol VoIP company. What made you want to do that despite this kind of difficult environment you were in?
I think when I did I think it was really ego, honestly. You know what I'm saying? And when I created my first company, it was a professional services firm, right? So straightforward model. You sell your time and your knowledge for a rate, and then you get paid for it, right? And hopefully, you get known for doing a good job, and you get more clients, and the existing clients like you and continue to give you work. But I guess in my mind, I thought, oh, this isn't a real startup. Like, this is just, professional services. It's like, this is just like consulting, right? I thought, you know what? I got to build a product. I've got to get a real startup, and a real startup is something where you build a product and you get funded, and you get X million dollars of VC money, and then you grow it and you become a multi-billionaire, right? That was my impression. So that's why I thought, I got to do this again, and this time do it right, and I put that in quotes, and that's why I started the second company, and it was basically a mobile VoIP application for feature phones. So this was sort of the mid 2000s, and the whole concept was that at that point in time, data was still very, very expensive. This is prior to 3G. It was edge, and we thought, and LD, long distance, was actually very expensive, right? And the model of most people, that there was a huge market for calling cards at that point in time because of LD. So we said, well, could we do this? Could we actually take that calling card and turn it into an application that you could download to your feature phone? So what would then happen is that the application would then import in all your contacts, right? And it would allow you to basically make a call, choose whoever. I say, like, let me call. I'm calling you. I click your name, click call, and instead of using the data channel to actually initiate the call, it would actually initiate it over the voice channel. And there'd be a server. Let's say you were in China and I was in Toronto. There'd be a server in China which call you locally, and there'd be a server for me in Toronto calling me locally. So for each of us would be a local call, but it was actually a long distance call. So the idea that was the fundamental premise, and then all the items that were always a pain in the ass with a calling card, which is having to dial all these digits and putting the PIN code and topping it up, would all be done in the app, right? So that was the primary premise of that startup.
Got it. And I'm not too familiar with that world. So my father used to be in a company that did long distance cards, and I've briefly looked at some companies that did, VoIP services when I was an investor. But it seems like from what you explained to me that it might have. Did you need to actually build out certain servers and stuff to actually be able to create this kind of local interfacing?
No. So the way that business works is that you actually have individuals that optimize point-to-point connections across data, right? So there are companies out there that may have a point of service, maybe in China, and then a point of service in Toronto, and then they'll sell you that link for a fixed fee of whatever, 2 cents a minute or whatever else, right? Your job as the person that's creating the app is to pick and choose these wholesalers of what's the best rate, and then put it all together so that when someone initiates it, you just choose the best routes for those calls, right? So there is this whole wholesaler model in that space, and obviously it's tied to volume, or some people have better deals because of different suppliers, different areas. So we didn't have to build that piece, but it was almost but we still had to find and optimize the legs for each element.
Got it. And so how did that do? Did you get that big venture funding?
Well, you know what I mean. We got to about 1 million downloads in 6 months.
Wow,
which is pretty amazing. I mean, and it was all basically based on referral freemium model. So the idea was, every time you refer someone, they will get $1 in free long distance, and then you as the person referring them will get $1 in free long distance. And a North American call like from Toronto to or Canada to US would cost you 2 cents. So that's pretty significant in terms of time, right? And maybe an international call would cost you 10 cents or 5 cents. It depends on the location, right? And that's how we actually drove sort of the volume to get to 1 million downloads.
And this is all happening in Toronto.
Well, there's actually, it was all actually most of our downloads were in Europe, in Europe and secondary countries like the Philippines and everything else. So in Europe at that point in time, there's a lot of regulation around point-to-point calls between countries. So you may, even though countries are beside you, it costs you a boatload, right? So there is this natural friction there, which to solve. And then there is this whole market where, you have a lot of migrant workers, and they're calling back locally, and then they found value in it.
And is that a market that you knew existed, and you saw it and you thought, okay, that's where the niche is, that's where we're gonna go?
Or no, we just launched and said, hey, let's just freaking launch this, put this out in some place and see what happens, and this is the model, and all of a sudden, you just see, holy smokes, this is where all the downloads are, right?
Wow. And this is in the mid 2000s when the world wasn't as connected, nowhere near as connected as it is now.
Yeah, it was pre 3G.
Yeah. Wow. And so then what led you to then go back to being a venture investor?
Yeah, so the one other thing we found about it is that it's fraud is a bitch in that space. There was a lot of fraud. So managing the fraud is very, very difficult.
How did the fraud happen? So can you give me an example of a typical fraud case?
Yeah, so people would just keep on opening multiple accounts and just using accounts and churning to each other, right? Or and it got to the point where it's like this is crazy because the problem was that the segment of the market that was really downloading the most, or just a segment which is lower in income and would be trying to find every way to scam the system to get more free minutes or free dollars, right? So that was one element, and then number two, after a while, we just realized, this is all raced to the bottom, right? And one of my big key learnings there is, I want to going forward. You don't want to price compete. You never want to price compete, right? Because there's always a race to the bottom. So we just thought, after a while, the space wasn't really a long-term opportunity.
And then after that, so I guess you guys closed down the company and then you went back to Rogers to build out more of their venture arm.
Yeah,
and
early stage stuff.
Yeah. Why back to venture? Why not something else?
Because I really enjoyed it. And I mean, I think that if you take a look at business as a whole, right, everything has to start somewhere, right? Everything has to start somewhere. Like it's any new idea, any new business. But the problem is that, getting it from 0 to 1 is so hard, right? And so being able to support that and build up that opportunity to get a company from 0 to 1 or getting to the point where they can actually make a difference was just intrinsically valuable to me. It's very easy to put another dollar into a large bank or into a multi-billion corporation because it's pretty safe. But it doesn't really change. It doesn't move the needle for the world, right? I mean, it doesn't, and there's not that much upside. There's not much change. There's not much. I'll call it incremental true value is created, right? I just fundamentally believe, and that's my only opinion, where most of the true value is created is at this very early stage where someone says, okay, man, there's a big problem here, or this stuff is way overpriced, for what you're getting. There's an opportunity to come in and disrupt the market and change things. Or, you know what, there's so much suffering here, or there's so much a big problem here. There's an opportunity to come up with something that's going to relieve some of that pain, right? And that's why it goes back to why I left P&G in the first place, right? Just increasing share of a recognized brand or something that's by 0.5%. It's don't get me wrong. I mean, it's really hard to do, and it takes a lot of skill sets and everything else. But it just wasn't something I was interested in.
And in regards to early stage, I think the definition is continuous. Some people use it differently. When you define early stage, do you define it by just like the financing round of like anything below Series A, so like angel, pre-seed, seed, or is it more the stage of the company, like pre-revenue or like pre-product?
So now, using your definition of why I stayed in early stage, I would define it as any company below $10 million in revenue, right?
Yeah.
I think in my experience is that once you get above a $10 million run rate for a company, you are almost like an adult. You can survive, right? Even worst case scenario, you can cut here, cut that. But you have something that you can either get to profitability pretty quickly, or at least EBITDA neutral, like break even pretty quickly, right? Below that, there's still a lot of things you're trying to figure out. There's a lot of unknowns, right? Which you're trying to figure out to get to that point of stability. That's just my personal opinion.
Yeah, no, and I think that kind of perspective is definitely valuable to have, especially from someone with like your experience set. And what comes to mind though is like you ran a VoIP company and it didn't work out, and so you went back to venture. And when I think in my generation, there's all these articles in Stigma about, oh yeah, you should just start a company early and just like, fail fast and use that experience, and people will say, oh, you're a big risk taker, and like people look at it really highly. When you went back to Rogers to be a venture investor again, was that a smooth process? Did they look at it highly and say, okay, like you've started a company, you've experienced it, come on back?
Yeah, you know what? I mean, the thing about it is, I think going back to Rogers is frankly two things. They needed someone. I was a known variable, right? Because I had worked with them before. I didn't leave on bad terms. I just said, hey, I want to try something myself. And then when I went back, they said, hey, the value that he got, I think as an operator the second time, was very useful for the space that they were looking at, which is more earlier stage, right? And that's so from that perspective, it was valuable. And you got to realize too that most of the money we raised, we didn't raise $20 million, right, for this company, right? We raised under $1 million, right? So, and we got quite far with that $1 million, right? Before you decide, hey guys, this is not going to work out. I think it's a different scenario where you see these people that are raising $20 million rounds, $15 million rounds, whatever else, right? I understand it, but I think from a VC's perspective, and I guess from an operator's perspective, I think for these burgeoning companies, if you're thinking of doing a startup, remember that when you raise money, right, it's not your money, right? It is someone else's money, and they believe enough in you to take the risk in you, right? So I have a friend, Matt. He's with Skull VC, and he always says, respect the capital, right? And you got to respect the capital. I mean, you got to. No one's putting you to the fire to say you have to succeed. Obviously, everyone wants to succeed, but you have to at least respect the capital and the people that put money into you, right? So I just think sometimes it's because no it's only usually the thing that you can really share that's not sort of confidential. Whenever you see PR releases or everything else, it's always about this person raised $20 million, $10 million, whatever else, and it's shared because you know what? That's the only thing that's really public, right? That can really go public. Everything else is kind of confidential. But there's this assumption that if you're raising more money, a lot more money, that you're really, really successful, and that's the case. I mean, obviously, no one's not gonna top up unless they think that there's an opportunity there. But you also got to realize the flip side of that is, as an entrepreneur, you have a lot more responsibility, right?
Yeah, no, I 100% agree with you. I think I had a few VC folks come on the podcast previously, and I think that still is a hot topic of entrepreneurs defining success by the amount of money you raise, or people who aspire to be entrepreneurs looking at people as being successful if they've raised X amount of money, even though the company might not actually still be viable or profitable, etc. And from your perspective, then, do you kind of have a kind of model of who should really be going for VC money, and which companies should be going for VC money, and which people really shouldn't? Is there kind of like a checklist that you recommend people kind of run through their heads of ask yourself these questions?
I mean, the thing about it is that the whole point of software in the first place is that theoretically, you get 3 or 4 really passionate people. They sit in a garage or in the basement or in their studies, at night or at home, or get themselves and hold themselves out for 48 hours for a hackathon. And the end of it, because it's all intellectual property, you should be able to build a product, build something, right? The whole point is that you don't have to have a manufacturing plant. You don't have to manufacture anything. The cost of creating something is a person's time, right? So I think that if you can't get to the point, personally, where you can actually build something on your own, at least in the software world, where you can actually prove sort of product acceptance or there's interest in it, then you shouldn't be raising money, right? Because even if you're like a business person, right, you know nothing about programming, as a good entrepreneur, you should be good enough to find other co-founders who are very good at programming. That you should be good enough at you should believe enough in your vision. They can convince 4 other people to believe in your vision as well, so they would spend, their spare time actually building up this product, so that you can actually get to like a prototype or an alpha, right?
Yeah, I think I was listening to an interview by Peter Thiel, who was talking about how one very kind of underlooked skill set a founder must have is the ability to storytell and convince people to join that entrepreneur's company. Because he was talking about the founders of Google, and he's like, they needed to tell people that we're trying to start this company and sell them on this vision without having anything.
So I always tell CEOs or up and coming CEOs or people that want to be CEOs, right? There's 2 things. Number 1, your job as a CEO, your primary job is to sell, right? You're always selling to customers, selling to investors, or selling to your people, right? Your employees, the people that are in your organization motivating, right? That is your primary job. And if you don't want to be doing that, you shouldn't be a CEO, okay? Because that is so important. You can still be a founder, but you shouldn't be the CEO. And the second piece you have to realize as a CEO is that, and this is I think what Elon Musk said is that, being a CEO is really hard because shit always rises to the top, right? I mean, a CEO is always dealing with the biggest problem at that point in time, right? And like in that big problem, like most people can't even realize how big it is, right? But you the CEO has to deal with it, right? So if you can't deal with shit, then probably the CEO is not a good job for you.
So for you left that investing world again, now the second time, to be an operator, and you chose the CFO path. So you became kind of a full-time CFO for 3 separate startups like Tribe HR, Kira Talent, and Touch Bistro as well.
Yeah. So I sort of got into that as like, Rogers had decided to move their VC group down to the Valley, down to California, and due to personal reasons, I couldn't go down, right? So I said, you know what, thanks, I just got around in Toronto because of personal reasons. So I'm thinking, oh man, what am I gonna do now? Because it's not like there's hundreds of VC jobs, right? So I thought, okay, well, where can I best apply my skills, and where is the biggest need, right? And what I found was that at least when I was dealing with other startups, like most of the time, these startups, you've got someone who can build really good product and can sell pretty well, right? But what comes on the financials and KPIs and metrics, probably the last time they saw a financial statement or really understood it was when they were doing their MBA, if they did an MBA, which was like probably 10 years ago, right? So it's just not a skill set that they have or they should be focusing on, because I don't know how much it moves the needle. But that translates into just having lower visibility, because sometimes you don't even know what you're tracking for and why it's important, right? So the one element is that whenever I spoke to early stage startups is, product's great, market's interesting, good salespeople. You look at all the numbers and it's a mess. It's just a mess, right? So you'd have to go through, take a look at it, and do your own analysis and try to figure out what are the real numbers, right?
This is when you were an investor.
This was an investor, right? And even later stage companies, right? And then the second piece is, number one is just understanding, I guess, the numbers and guiding the company from investors and from a metrics-based approach. And the second piece is that even being able to put in and define the correct infrastructure so you can get those numbers, right? I mean, you talk to most people, right? Maybe they came out of a mid-sized company or they were someplace else. All the accounting is basically all done for them, right? I mean, it happens in the background. You send an invoice someplace, or you create an invoice. You don't even see that piece, right? It just sort of magically happens in the background, right? And all of a sudden you get your numbers, right?
You get all these KPIs, and you
go,
okay, now I'm going to analyze all this.
Yeah, not going to analyze this, but all of a sudden you get your report, and it's done, right? But when you're doing a startup, like, that's not there, right? I mean, it's not there. Like, you have to build that, and you have to, even when you go to a bookkeeper, right? They'll code your transactions in the right area, but they're still not gonna tell you what it means. They're not gonna tell you where to code it. Like, you have to tell them what it is. They're not gonna tell you the right places to accrue it. If you're sending an invoice, they're not gonna chase after that customer if they're not paying, right? And let's say you're in a cash crunch, they're not gonna tell you, okay, we'll pay this person first and let's pay for this person second, or they're not going to go out to that supplier and say, hey, sorry, man, we're a bit of a cash crunch. I need to renegotiate my payment terms, right? I mean,
these are all things that you had to do when you were in the CFO role.
No, I mean, well, most of it, you know what, I would say most of it is the collection side. I mean, it's just like, you know what, you send the invoice out, and then some people pay, some people don't, but you gotta, it's just a fundamental part of business, right?
Yeah, you got to get the cash in.
You gotta get the cash in, right?
Yeah.
You gotta get the cash in.
And so what do you think, like when people first do like a finance role at a startup, or when you're creating that kind of role, like what's the thing that matters the most, and what are the things that people focus on that really should be ignored?
So I mean, in the end, I mean, there's two things to a startup. One is building a product. It doesn't even have to be a great product that people will buy, right? And number two is selling it. like those are that's the core purpose of a business, right? Like frankly, everything else is important, but it's not the core of the business. Everything else is important, but it's a table stakes, but it's not going to move the needle for you, right? Moving your needle is how do I prove that product, and how do I sell it, and how do I get to the right people? How do I acquire a customer, right? So that's what, as founders, you should be focused on the most. And that was my belief, is that, you know what? So if you can have someone else, like a fractional CFO or COO, to go through and help you with all the other stuff at that point in time, because it could be still pretty small. You're not doing a crap load of stuff. And it's like a cost effective for you, then that's what you should be doing, right? Because for you to be able to actually do the sales and actually do the product, you need to have visibility into your business.
And you also mentioned about how your role within corporate is actually putting in systematic infrastructure, actually making the operations efficient, effective. Are the right numbers coming in? Are the right forms going out? And there's all these tools now that are out there that can actually aid a lot of startups. Do you have kind of a go-to toolkit of these are the softwares I use? Yeah,
I mean, I think so. At early stages, it goes across the board. I mean, like what, usually what happens is, it's either obviously QuickBooks or it's Xero as your accounting platform, and then if you go sort of downstream, or I'll call upstream, I guess, in terms of invoicing of your SaaS-based business, then there's some stuff like CheddarGetter or ChargeBee. They're all the same, and then going up source more. Most people use Salesforce, and then some people just use some sort of platform for managing demand gen, right? But those are the core systems that you really need.
And would you say then, when you are actually being the CFO of these startups, do most of your time go into building out the infrastructure, or is it more just
most of your time goes into defining the infrastructure? It's like you know what I mean. It's like what I say to a lot of people is software is not going to solve your problem unless you know how to configure the software. Just like you have Excel. You can be the best person at building on an Excel model, right? But if the algorithm is wrong and doesn't actually reflect the key drivers and levers of your business, it's just sort of pointless, right? Garbage in, garbage out. It's just same with other things, right? You can have all the software, it can have all these bells and whistles, but you have to configure it and design it in the right way so that it actually is meaningful to your business.
Do you try to keep it flexible enough so that if the business model does evolve or change dramatically, that it can tailor to it? Or do you just find that you do it so it fits the current business model, and if it does completely shift, then you just create a new infrastructure for it?
Yeah, well, I mean, the thing about it, the theory is that, as if you have a good piece of software, as your business evolves, it's pretty easy to reconfigure, right? That's the theory around it, if you have a good piece of software.
Got it. And so you were more, so right now you're a fractional CFO, but in the beginning it seems like you were more of a full-time CFO of a startup, like one at a time instead of four at once.
No. I was, like any company, it takes a while to build up your clientele, right? So I was a little over 6 months, and I got my second client and everything else. So I was always a fractional CFO, okay. But it takes a while you don't. It's not like you start off your company all of a sudden, hey, I've got friggin' 20 customers, great, I'm done.
Well, you're telling me that all the startups didn't, like beg for you and say, come on, Jason, can you be a CFO for us?
Yeah, I wish.
And so you started being a CFO, and then you went back to being an investor too, right? You went to Gibraltar, and then you were an investor, and then you came back out to being CFO.
Yeah.
Why the third time? Is it third time's the charm?
I think third time's the charm. Well, you know what I mean. I think I was. So I know it's a lot of ping ponging. I think going back to the investor side, I just realized I could move the needle more. Going back to the investor side, I just realized I enjoyed the work as a CFO more than I enjoyed the work as an investor. Just because as an investor, you only have so much you can do to move the needle for your customer, for your investments, right? You can only there's only so much you can do. I mean, your focus is to manage your portfolio, right? So, and you only have so much time, and you got to raise your next fund and all this other stuff, and so you can only do so much for your investments. And what I found that as a CFO or a part-time CFO, I could do a lot more to move the needle and get a company from 0 to 1 than I could as an investor. So my original thought was, the reason why I got back into investing is I thought, hey, I'm doing the CFO stuff. I can see that, when I'm involved, I can actually help move the needle. I mean, I can actually see a change in terms of the numbers and the discipline and being able to actually push everything to the top to the right. And I thought, hey, well, man, if I can do this, and then maybe, well, what's the next thing? What's another thing that people really need? They need capital, right? So can I sort of merge this knowledge, this ability, and then be able to deploy capital against it to be able to move these companies to the top and to the right? And that was the original concept why I got back into VC, right? And the idea behind it was that my differentiation, I'm an operating VC, right? The goal was hopefully, maybe my focus would be, let's see if I can get in there, make the investment, and still my value add would be to do this CFO work for these companies, right? To try to, change the probabilities of success. But then I realized that it's tough to do because we only have so many hours in the day, right?
And so when you I know you went to say something else, but I was really curious. When you said it was tough to do because there's only so many hours in the day, was it not possible to kind of offload? Okay, well, we already invest in these portfolio companies. I'm going to work on them and ask a different venture partner to screen more companies, do more relationship building.
Yeah, you can, but you got to realize that. I mean, you only have, there's a management fee to help you cover your costs when you're going through. You only have so much management fee, right? It's not like you're unlimited resources, right? And so you just you got to be sort of doing everything. Like a VC is an entrepreneur themselves, right? And they've got to manage everything and build everything, right? And then I think I just found that you just could. That was a difficult model to execute against at scale.
Was there kind of was there a specific inflection point where you realized I want to go back to being a CFO?
Yeah. So I think I decided, like everything else, VC has its own life cycle. Usually the model is for a 10-year fund, you spend, however much time you spend raising the fund, and then within the first 3 to 4 years, you deploy against that, right? And then at that point in time, you raise fund 2. So we were at the point where there was a decision whether we're going to waste fund 2 or not. And I said, you know what? I think that, at least from my personal perspective, I would find more value, and I can help companies more as just purely a fractional CFO. So that was a route wanted to take, because I didn't want to go back and, you can't just go back and promise to new LPs, yeah, I'm here, and then, just leave a year after, right?
And I think, like that comes back to the idea of, even for, you talked about how for entrepreneurs, when you get venture funding, it's not your money.
It's not your money. Yeah, it's someone else's money, and you have a responsibility to do what's right for your LPs.
Yeah, no, totally. And so right now, as a fractional CFO, do you have those moments though where you think back to, do you have that urge of, should I go back to be a VC for the fourth time?
No. I mean, I think I've finally learned my lesson.
You have conviction?
I have conviction. Yeah.
And so as we kind of hit up on like the final legs of our interview, for you personally, then, from what you've experienced so far, being involved in so many different aspects of the startup world, and this doesn't have to be relatively focused on the startup tech world necessarily, but is there an aspect where you feel that you have a belief that is against conventional wisdom, whatever that conventional wisdom might be?
Yeah, you know what I mean. Just going through this. I mean, the whole model of this. I think of the VC world, the investment world, as push hard, go fast, own the friggin' market, and then dominate, and then that's how you get your highest multiple, right? Because if you have a very, very fast growth curve and a large market, and your top line's growing really quickly, then that's how you get the big returns, right? But I mean, I think that's sort of the top line, but never underestimate the power of cash flow. You know what I'm saying? And I think sometimes you need to go slow to go fast, right? I think sometimes it's better to slow down your investment in people or whatever else, or areas of focus. Figure out what works, what's working really well, then lean in. But sometimes I think generally people are just so focused. I gotta get to this specific growth rate so quickly that they're just trying everything across the board to figure out what works, right? And I think half of that is just, as I said before, it's just you don't have that same visibility into your business to figure out what is working, what's not working, and where you got to focus on, and to be more of a sniper than just a shotgun approach. And that's why you need someone to help you get to that visibility.
And I think that's a wonderful belief right there. And I think there are similar, I can see that kind of analogy in like other forms of investing as well. Like one person that pops to mind is Stan Druckenmiller, the famed hedge fund manager of Duquesne, where he talks about how even him as an investor, he believes that what's important for him is to actually know when he's hot and know when he's cold. And when he's cold, it's about being slow and actually being very methodical and try to think more and take some more free time and focus on where do I focus on. And when he's hot, that's when you double down and really go hard with conviction in something. And I think that's definitely a great sentiment to hold for any startup entrepreneur. And so with time winding down, Jason, thanks so much for coming on the podcast and sharing your story with me and my audience. Really appreciate it. And if there are some people in my audience who are startups and startup founders and who want to engage in your services, where can people find you, learn more about you?
Yeah, just start email me. I'll work through networks, so I don't advertise. But my email address is jason@jasonzan.com. So just email me there.
All right, great. Thanks for coming on the podcast, Jason.
Okay.
So thanks for listening to the podcast. If you enjoyed what you heard, please check out other episodes and don't forget to subscribe to stay up to date for the future episodes. Also, I would really appreciate it if you would leave a review on iTunes, Google Play, or Stitcher, whichever is applicable to you. To see past episodes, you can go to oldmandan.com/podcasts. Also, you can sign up to my weekly newsletter on my blog, oldmandan.com/newsletter. You can stay up to date with future podcast episodes that way, and included in the newsletter are my book reviews I write, my weekly article related to the domain of self-development systems, as well as 7 things I learned throughout the week on being healthy, wealthy, and wise. Finally, special thanks to icons8.com for allowing me to use their music Tiny People on the podcast. Great. I will see you all next time. Take care.